How does the double declining balance method work for calculating depreciation? Let's go through some examples, step by step, to make the double declining balance method come alive. Let's work with a capitalized value or purchase cost of $100,000. A residual value, also known as salvage value, scrap value or trade-in value, of $7,776. That sounds like a strange amount to use. I will explain you why once we have made our depreciation calculations. And finally, an estimated useful life of 5 years. Based on these parameters, the amount to be depreciated is $92,224, which is the difference between the capitalized value and the residual value. In the straight line depreciation method, you use a depreciation rate of 20% in this case, which is simply 1 or 100% divided by the number of years, which is 5. 1/5 per year, 0.2 or 20%. In the straight line method, this depreciation rate is applied to the amount to be depreciated in the row above, in order to calculate depreciation expense. In the double declining balance method, you depreciate at double the speed. 2 times 20% is 40%. You apply this depreciation rate to the book value of the asset, not to the total amount to be depreciated. As the book value is declining every year, depreciation expense is also declining. Let's see what that looks like. Straight line depreciation on the left, double declining balance depreciation on the right. For both of these methods, I have composed a table consisting of the year number, the opening book value for the year, the depreciation expense, accumulated depreciation, and the closing book value for the year. Straight line depreciation is beautiful in its simplicity. The opening book value is equal to the capitalized value. Depreciation expense is the same amount every year. The amount to be depreciated multiplied by the depreciation rate. Accumulated depreciation is the sum of the history to date depreciation, which in year 1 is equal to just the depreciation expense of year 1. For year 4, the accumulated depreciation is equal to the sum of the depreciation expense in years 1 through 4. The closing book value for the year equals the opening book value minus the depreciation expense of that year. The opening book value for year 2 equals the closing book value for year 1. You keep going this way every year. The same amount of depreciation expense, accumulated depreciation going up over the years, and book value going down until you reach the residual value at the end of the last year. In the double declining balance method, depreciation expense is calculated at double the rate of straight line depreciation, but applied to the book value of the asset. In year 1, 40% of $100,000, which is $40,000. In year 2, 40% of $60,000, which is $24,000. In year 3, 40% of $36,000, which is $14,400, and on and on. Same percentage every year, but applied to a declining balance of book value. When using the straight line method, depreciation expense is the same every year, which is very appropriate if you depreciate a machine that produces the same number of units every year. When using the double declining balance method, depreciation expense is much higher in earlier years than in later years, which is appropriate for assets that are more productive in their early years, and/or assets that lose value quickly, such as vehicles. The other big advantage of the double declining balance method is that depreciation expense is tax deductible. So most people would say, the more I can depreciate as soon as possible, the better off I am. So why am I using such a strange number of $7,776 in residual value? Because that's the only residual value in this specific example where you can use a simple double declining balance calculation. It gets more complicated when the residual value is higher or lower. What happens when the residual value is $20,000? Using the straight line depreciation method, depreciation expense is now $16,000 per year, and we depreciate from the capitalized value of $100,000 to the residual value of $20,000 in 5 years. Using the double declining balance depreciation method, depreciation expense stays at 40% of the opening book value for the year. And we keep depreciating until a residual value of $7,776. Surely that can't be right. We shouldn't depreciate to a book value that is lower than the residual value. Let's replace the formula for depreciation expense with a more complicated formula that takes the residual value floor into account. This new formula for depreciation expense takes the lower amount of two numbers. Either the depreciation rate times the opening book value, like before, or when the opening book value gets very close to the residual value, in year 4 of our example, it takes the difference between that opening book value and the residual value. With this new and improved double declining balance formula, the depreciation expense is fully booked in the first 4 years. There is no depreciation expense in year 5, and the closing book value at the end of the useful life of the asset is equal to the residual value of $20,000. If you don't like building your own formulas, then Excel offers you a pre-cooked solution, the DDB formula. DDB for double declining balance. When you look at the function arguments, you see it's just a matter of referring to the right cells in the right place. Capitalized value, salvage value, useful life, the period number for which you want to calculate depreciation expense, and the factor that you want to apply to the depreciation rate. The default for factor is 2, which is double declining balance, so we can leave that empty. This gives you the exact same outcomes as using the min functions that I've just used. Sadly enough, these version 2 formulas help you in some, but not all, possible situations. What if we set the residual value to $5,000? Using the straight line depreciation method, depreciation expense is now $19,000 per year. And we depreciate from the capitalized value of $100,000 to the residual value of $5,000 in 5 years. Using the double declining balance depreciation method, depreciation expense is 40% of the opening book value for the year. And we keep depreciating until a closing book value of $7,776, which is incorrect as the residual value is $5,000. We can fix the formula in order to deal with this situation as well. Version 3 of the double declining balance calculation adds a layer to the formula that checks for the last year of the useful life what the difference is between the opening book value and the residual value, and puts that number into depreciation expense. If the year number in the depreciation table equals the estimated useful life, then calculate the difference between opening book value and residual value. If the year number is different from the estimated useful life, then proceed as before with taking the lower amount of two numbers, either the depreciation rate times the opening book value, or the difference between that opening book value and the residual value, whichever is smaller. Great. Another scenario solved. What if we now go to a residual value of 0? Our latest version of the formula addresses this situation by ramping up the depreciation expense in year 5 and getting to a closing book value equal to the residual value of 0. But it looks very strange to have a declining amount of depreciation expense in years 1 through 4 and then a sudden increase in depreciation expense in year 5. How do we fix that one? This is where we get to the ultimate Excel formula for double declining balance depreciation, the VDB formula. Variable declining balance uses the double declining factor, but also initiates the automatic switch to straight line depreciation once that is greater than double declining. In other words, when using the VDB formula, depreciation expense initially declines and when needed stays the same in later years, but it will never jump back up. Let's look at the function arguments. Capitalized value, salvage value, useful life. Then we need to specify start period and end period. By referring to the cells with the year number, we make these dynamic formulas. For the first row in the table, We want start period to be 0 and end period to be 1. Then there are two optional fields. The factor that you want to apply to the depreciation rate. The default for factor is 2, which is double declining balance. So we can leave that empty. And a no switch option in case you don't want to switch to straight line depreciation when needed. We leave this empty as well. We now have a functioning formula that can deal with a large variety of situations. However, the double declining balance depreciation method, by its very nature, can still have some unusual patterns. If the residual value is $50,000, then the bulk of the depreciation expense is in year 1, the remaining depreciation expense in year 2, and then no depreciation expense in the last 3 years. It gets even stranger if you depreciate in 2 years. The straight line depreciation rate is 50%. The double declining balance rate is 2 times 50%, 100%. Basically, you then expense the asset fully in year 1 when using the double declining balance method. Yet another situation where it doesn't feel right. For simplicity as well as accuracy, I very much prefer straight line depreciation over double declining balance depreciation.